Welcome to the deep dive. Today we're really digging into something foundational. We're essentially sitting down with Benjamin Graham, the mind behind The Intelligent Investor.
Yeah, it's a classic for a reason.
Absolutely. And this deep dive, it's not about finding hot stock tips or like a quick path to getting rich. Our mission here is more about extracting Graham's timeless wisdom,
Right.
giving you a kind of blueprint to cultivate a mindset, one that builds lasting financial security and real insight.
It's such a powerful distinction to make up front because Graham, this is Warren Buffett's mentor we're talking about. He wasn't offering some get-rich-quick scheme at all.
No.
He was providing a really profound way of thinking about markets and, about money itself. This deep dive is genuinely about stepping inside that mind, the mind that built fortunes, not through, gambling.
Right, not luck.
But through pure reason and solid strategy.
So let's unpack this figure a bit. Graham, the source material, it mentions he didn't exactly start wealthy. He came up from poverty, built his fortune.
Yeah, quite a story.
And what strikes me is how he did it by thinking just fundamentally differently, especially when the world was, kind of in chaos.
His emergence after the Great Depression is particularly key, I think. Investor confidence was just shattered, completely gone.
Understandably.
And yet here comes Graham introducing this really counterintuitive idea. It basically reshaped how people viewed the market.
That famous quote comes to mind.
Exactly. He said, the market is a voting machine in the short term, but a weighing machine in the long term. And that wasn't just, a catchy phrase.
So it cut deep.
It was a radical reframe. It taught investors to basically ignore the short-term emotional noise.
The voting.
Yeah, the popularity contest. And focus on the long-term fundamental value, the weight. Which, let's be honest, is something most people still struggle with today.
Oh, definitely. Which leads perfectly into one of Graham's best analogies, right? Mr. Market.
Ah, yes, Mr. Market.
I can almost picture this guy showing up some mornings looking completely frantic after, some bad news cycle. Can you maybe paint that picture a bit more? What did Graham want us to learn from this whimsical partner?
Sure. So imagine you have this business partner, right? Mr. Market. Every single day he shows up and he offers to either buy your share of the business or sell you his share.
Okay.
But here's the thing. His prices are, all over the place. They're based entirely on his mood. Some days he's super optimistic, almost euphoric.
Buy prices.
Exactly. He'll offer way too much. Then other days he's completely depressed, desperate even, and he'll offer to sell his share for peanuts.
So the prices are wild.
Completely wild. And the crucial takeaway, Graham's main point here, is that you as the investor, you are under no obligation to trade with him just because he showed up. You don't have to follow his mood swings. You only act when his price makes sense for you, based on your own judgment of value.
So that's lesson one,
Okay.
essentially. Be rational.
Be rational. The market, Mr. Market, exists to serve you with potentially attractive prices now and then. It doesn't exist to dictate your actions or tell you what your assets are worth minute to minute.
That analogy is just brilliant for illustrating emotional discipline. But, thinking about today's markets, hyper-connected, news flashing constantly, isn't it way harder now to ignore Mr. Market's daily moods? How does that lesson hold up?
That's a great point, and I'd argue it makes the lesson even more critical today.
Okay.
Because the noise is louder, right? The temptation to react to Mr. Market's latest panic or euphoria is constant. Graham's lesson is about building that internal conviction, that discipline to stand apart.
So if you let him dictate your moves.
You're basically letting, as Graham might put it, a manic depressive partner run your financial life. The real takeaway is about controlling your own emotions, not letting the market's apparent emotions control you.
Makes sense. So beyond understanding the market's character, Graham also looked at the investors themselves. He sort of categorized them. There were two main types, right? First, the defensive investor. What's that about?
Yeah, the defensive investor, this is someone whose primary goals are safety and consistency. Avoiding big losses is key.
Okay, sounds cautious.
It is. They often choose things like, diversified index funds, maybe some high-grade bonds, established blue-chip stocks with long histories. It's very much the slow and steady approach. Less effort, minimal mistakes.
All right, and then the flip side, the enterprising investor. Sounds more hands-on.
Definitely more hands-on. The enterprising investor is someone who's willing to put in the work. We're talking extensive homework, deep analysis, trying to find specific stocks that the market has undervalued.
So potentially higher returns?
Potentially, yes.
Yeah.
But it's also inherently riskier if you don't do that homework properly, and it demands significant time and skill. It's not for everyone.
But what's interesting is despite these different approaches, defensive versus enterprising, Graham had a core rule for both, didn't he?
He did, and it's unifying. For both types, the rule is know what you own and why you own it.
Simple, but profound.
It really is. It forces you to think critically regardless of your style, which actually raises a good question for you listening. Which path feels more aligned with your own temperament, your goals? Defensive or enterprising? Something to mull over.
Definitely. And building on that idea, knowing what you own, understanding its value, that leads us straight to Graham's maybe most legendary contribution, the margin of safety. This sounds like your ultimate sort of financial shock absorber.
It absolutely is.
Yeah.
This is pure Graham, and it's deceptively simple but incredibly powerful.
So how does it work?
Before making any investment, the intelligent investor asks, what's my margin of safety? Graham used a great analogy. Think about a bridge.
Okay.
If a bridge is rated to safely carry, say, 10 tons maximum load, you wouldn't drive an 8-ton truck over it, would you? Or worse, a 10-ton truck, right on the limit.
No way. Too risky.
Exactly. You drive maybe a 4-ton truck, you leave ample room, a wide margin for error, for unexpected stress, for things you didn't account for.
So you apply that same logic to buying stocks.
Precisely. Investing with a margin of safety means buying an asset only when its market price is significantly below your estimate of its intrinsic or real value. You build in that cushion.
That's fascinating because, again, it feels almost counterintuitive today. So much focus seems to be on taking calculated risks, maybe pushing closer to the edge for higher returns. But this principle, it really reframes it, but suggests the best investors aren't really the biggest risk taker.
Not at all. They're risk managers. That's the key.
Risk managers, I like that.
Yeah. And this margin of safety principle, it wasn't just some cautious little tip for Graham. It was the ultimate protection. Protection against market craziness, against unforeseen problems, and frankly, protection against your own inevitable mistakes and valuation.
So it shields you from Mr. Market's bad moods and maybe even from yourself sometimes.
Exactly. It turns raw, uncertain risk into something more manageable. Managed uncertainty.
Okay, so we've got understanding Mr. Market, choosing your investor type, defensive or enterprising, and always demanding that margin of safety. So who then ultimately is this intelligent investor Graham talks about? It's clearly not just about having a high IQ or trading all the time.
You're spot on. It has almost nothing to do with IQ points or how often you trade. For Graham, the intelligent investor, it's about character. It's about temperament.
Character? How so?
Well, it's the person who stays disciplined when everyone else is panicking, who remains patient when others are chasing the latest hot trend, the hype, who stays logical when the broader market seems to have, completely lost its mind.
Being the rational one in an irrational crowd.
That's a huge part of it. And Graham had this really quite poignant insight about the emotional side. He said, to be an investor, you must be emotionally prepared to watch others get rich, doing things you avoid.
Oof. That one really hits home, doesn't it? Because it is so hard sometimes to sit on the sidelines, stick to your principles, when it looks like everyone else is making easy money on something you decided was too speculative or too expensive.
It's incredibly difficult. FOMO, the fear of missing out, is a powerful force.
So why is resisting that emotional preparedness so crucial?
Because that discipline, that ability to resist the emotional pull of the crowd is precisely what prevents you from making huge, potentially devastating mistakes.
Yeah.
Jumping into a bubble just before it pops, or panic selling at the bottom, those are emotionally driven errors.
Right.
If you connect this back to the big picture, investing, the way Graham saw it, it's less about watching external market movements and much more about managing your internal psychological state, your resilience, your consistency, not letting fear or greed dictate your long-term strategy.
So ultimately, this whole deep dive into the intelligent investor, it really makes it clear, doesn't it? The true intelligence Graham valued wasn't in complex charts or predicting the next big thing.
Not at all.
It's found within you, within the listener. It's about your habits, your mindset, your discipline, and crucially, your patience.
Beautifully put. And, in a world that's just constantly throwing quick fix tips and noisy trends at us, Benjamin Graham's core message is like this quiet, timeless whisper. He reminds us, investing isn't about beating others. It's about controlling yourself. It's about never beating yourself through your own emotional reactions or lack of discipline.
Never beating yourself. That's powerful. So as you reflect on all this, maybe a final thought to chew on. How might these very principles, discipline, patience, rational decision-making, which are so vital for intelligent investing, how could you apply them to other big areas of your life?
Interesting question.
Yeah, think about building long-term value, real well-being, maybe beyond just your financial assets. Because, as Graham implies, wealth built slowly, thoughtfully, is often wealth that lasts. Maybe that applies to more than just money.